Hello, everyone, and thank you for joining us for today's webinar, Tax Update, Vehicle Deductions. For you receiving or signed up for CE, you'll receive the certificate within 48 business hours of the presentation. So let me start by going through the webinar pane. You can maximize or minimize the webinar pane during the presentation by using the red arrow buttons. During the webinar, we also encourage you to ask questions. In the webinar pane, you'll see a chat box that you can use to enter those questions. Just type the question and click submit. Our presenters will answer those questions as time allows, either during the presentation or at the Q&A session toward the end. Now a quick review of your audio settings. If you're using a telephone, please click on the telephone audio mode, or if you're listening through your computer, then please click on the mic and speaker option. And please note that you will be receiving a copy of this presentation after the webinar. I'll be sending it out to you, so if you want to take some notes, do take them, but you'll see the slides after the presentation. And quick note about CE, you must use a personal computer, no PDAs, and log in with your own information and unique URL. You must be logged in to our online software for at least 50 consecutive minutes within the scheduled time frame of the webinar. You must actively respond to at least 75% of the polling questions. There are 4, which means you will need to answer 3, and you must complete the evaluation survey at the end of the webinar. And now a quick introduction to our presenters. Our first presenter is Dan Jones. He's a tax partner with Armanino. He has more than 20 years of experience helping clients identify the best strategy to reduce their tax risks. His clients appreciate his ability to understand complicated tax issues such as ACA and, of course, vehicle deductions, and identify the best strategies when planning to take advantage of those benefits. Our second presenter is Stephanie Eustace. She has more than 10 years of experience helping clients identify the best strategies to reduce their tax risks. She joined Armanino in 2006, and she works with a wide variety of clients, such as closely held businesses and individuals. She earns her master's degree in taxation from Golden Gate University. And with that, a quick review of our learning objectives. So during today's webinar, you'll be identifying the differences between business versus personal use of vehicles. You'll discuss depreciation of vehicles, and we'll explain how to account for business use of vehicles. And with that, I'll turn it over to Dan for a quick overview.
Thanks, Debbie. So we're going to concentrate on 2 things today. The first part will be looking at what's the difference between business use and personal use. Then after we discuss that, we're going to go through calculating some deductions. So we'll look at the actual versus the standard, including some depreciation examples. And then finally, we will take some questions if you have any. With that, let's get started. Now, this cartoon is kind of funny to me in that no matter what happens, I always get the question about, can I deduct my vehicle? It's very important to everyone. In fact, just about this time of year, I start getting the questions, hey, should I buy a new car? Well, I think for some reason that's psychological to people. They feel like they're getting off on the government because you're going to own a car anyway. So if you get a deduction for it, all the better. But let's talk about the pitfall of that kind of thinking. So let's take a look at business versus personal. First off, the government does not want to subsidize your vehicle for personal use. So the business use is all important. And let's start off, first off, what isn't business use? And what that is your commute. So you drive from your home to your workplace. That is not considered business use and is not calculated as part of your auto deduction. And it doesn't even matter how long your commute is. So if you are commuting 50 miles versus 5 miles, it's still considered a commute. So that distance does not matter whatsoever. So I think that's where a lot of people get fouled up, is they figure their commute is going to be their part of their business use because they're driving to work. But no, that is considered personal. So now you ask yourself, are there any exceptions to this? And luckily, you have to be able to deduct your business use. And what are some of the exceptions to commuting? The first is if you have to travel out of your metropolitan area for a temporary workplace. And what is considered a temporary workplace? It's something that is going to take less than a year to happen. So if it's open-ended, and it could take a year and a half, 6 months, 2 years, then it's not considered temporary, and it would be considered your permanent workplace. And the drive there would not be deductible as business use. But as long as it's temporary, meaning it can happen under a year, then your drive from your home to that temporary work location will be deductible. Now, what is outside your metropolitan area? And that's kind of a facts and circumstances, and it's not actually defined. So there's a lot of controversy in that. Generally, you're going to look to whether or not it's where you normally work. So for instance, Oakland to San Jose would be considered outside your metropolitan area. In fact, there was one court case that the IRS was trying to say that an 80-mile radius was part of the metropolitan area. Taxpayer came back and said, no, mine's 35 miles. And actually, the tax court agreed with them and limited it to 35 miles. So that's one test some people use, is this 35-mile radius. But like I said, it's not defined on that, and you really have to look at your actual metropolitan area. And there's a lot of cases arguing that. But generally, people's common sense is right, and you can figure out what is outside metropolitan area. Second exception is if you have multiple work locations. And the key to that is you have to have one place of work that's your main place of business. So for instance, say you're a CPA and you have an office in San Ramon, California. And you then have to go out to different clients to perform audits or consulting. Well, because you have your San Ramon office, these other temporary work locations are considered business deductible. And in this case, it doesn't matter how far it is. So it could be 10 miles versus 50 miles. It doesn't fall under the temporary work location rules. If you don't have a primary location of working, then all of your locations are considered temporary, and they would have to fall under the first exception in order to be deductible. And one thing to note is that if you're going between work locations, that's always going to be deductible. We're really just talking about from your home to that first work location. And another thing to note is with the multiple work locations, they have to be in the same business. So for instance, if you're a contractor during the day, but you also have a dance gig that you do at night in, say, San Francisco, those are two separate business locations, and they don't count as multiple work locations. They're actually considered to be both your primary work location, and any drive from home to either place would be considered personal use. Okay, now the third exception, which we kind of call the holy grail of auto deductions, is if you have a home office. And why is that the holy grail? It's because anywhere you go from there is considered business because you're not commuting, you're at home. So that really, really gives a good benefit for the home office deduction. And a lot of times people wonder, I wonder if I want to bother with the home office. Well, in this case, if car travel is a big piece of what you do, that is a good advantage of having that home office. And so it has to be a place where you regularly perform business. And there are a lot of IRS cases on the home office. And you want to make sure that, which is outside this webinar, make sure you kind of understand that before you just say, I'm working at home, anywhere I commute is deductible. All right. Now, one of the worst things I get with clients is I get an audit notice and I look back and their business use is 70%, 10 straight years, exactly 70%. And they've really just estimated what their business use is. And then when the auditor comes in, it's Halloween candy time for them because there's no backup, no documentation on how that business use came about. And they just write it off saying it's all personal. And the reason is it's really a pain to do the recording because every time you go somewhere, you got to record what the business purpose is. So what are the key elements you need? At a minimum, if you're going to deduct auto, make sure at the beginning of the year that you write down your odometer reading. And at the end of the year, write down what you had at the end of the year because you're going to need that total miles for the year. So that's at a minimum because you can always potentially go back and fill in some of the blanks. For instance, as a CPA, you have to record your time. So you're going to probably have time incurred when you went out to a client. And you can go back and say, here's the business use to that client. Here's the next. It's supposed to be contemporaneous, but I've seen a lot of auditors allow that kind of thing where you actually have records to back it up. And really your timesheet would be contemporaneous. Or if you make plumbing calls, you can print off the invoices there. But that's really hard. And all of a sudden you're going back and it could take hours and hours. So I don't recommend it. In fact, when I first started, we used to hand out these little booklets that you would hand write in what your business use was, the client you went to or the job you went to, how many miles, time, date. And I think only the engineers actually filled that out. All our entrepreneurial clients never filled it out. And so it's always a struggle. The other thing you always need to record is, of course, your business miles. If you're going to use actual expenses, which we'll talk about later, you need to also record when you place that car in service and what you paid for it. Now, Stephanie, I'm old school here, but what do you younger people do when you're recording these business use?
Well, Dan, actually there's good news because now with all the technology available to us, there are quite a few apps you can use to help track your mileage. And since there's so many options, you are likely to find one that works well for you if you just take a minute and look.
Yeah, so that makes it a lot easier these days. Is you can get your app. When you get in that car, just start it, put down your business use, and go about your business. Why don't we take a look at our first polling question?
Thanks, Dan. So as a reminder for those of you joining us for CE credit, you have to answer 3 of the 4 polling questions. So make sure you answer this one and you won't have to worry about it later on. So question 1, or actually true false, there are no exceptions to commuting classified as personal use. Is this statement A, true, B, false, or C, you're not sure? And as a reminder, I'll be sending out these slides after the presentation, so Do take your notes, but you'll have the slides shortly. We'll give you about 3 seconds to wrap up this question. We'll close the polls in 3, 2, and 1. And it looks like 61% said false, Dan.
Well, let's review. There actually were 3 exceptions to that, if you recall. They were 1, commuting to a temporary work location. 2, commuting to a job location when you have multiple jobs. So for instance, the example there was a CPA that's main office is in San Ramon, but travels to different workplaces to perform audits or, consulting. And the third was if you have your office in home. So I think that's kind of a little trick question there. It's really, there are those exceptions to the commuting. And that's really important because that's where you get your business deductions from those exceptions. One thing we didn't talk about was, what is considered some business use. And that would be things like visiting your CPA for business. You could go get supplies for your job, going out to customers, going to court to file liens, etc. The only thing we're concerned with is that just your drive from your home to your first work location. That's personal. Everything else related to the job is going to be business deductible. Okay, so now the next thing we're going to consider is employee versus business owner. Most people own a car, and most people have a job. So right then you start thinking, can I deduct my car for my business use of it? And the answer is generally yes. So first, let's talk about if you're employee owned, meaning whoever you work for does not own your vehicle. And keep in mind that could also be a sole proprietor that has incorporated their business and own 100% of that stock, because that person is still an employee of their business. So it will apply to them as well. So the first thing we look at is, are you going to be reimbursed for those expenses, or are you going to deduct those on your tax, directly on your tax return? Now, let's look at the first case. So you're an employee, you get reimbursed for your business use of your auto by your employer. The first thing we look at is that an accountable plan or a non-accountable plan? First, let's talk about a non-accountable plan. So that is, you're a salesman or an executive, and you're given an auto allowance, and that's, say, $200 a month. But you don't have to tell your employer what you're using that for. You can spend it on, it doesn't necessarily have to be auto. You could only commute, but you're still getting that $200. Well, that is a non-accountable plan because you're not actually documenting your business use. And in that case, that $200 per month is going to be added to your wages as compensation. So you'll have to pick that up as income. Your employer will then deduct it as a wage deduction. A better idea, at least for an employee, is you have an accountable plan. And with an accountable plan, you have to submit what your actual business use was to your employee. So instead of getting a flat $200 a month, you can say, well, I drove here, there, and the other and get reimbursed for that. But because that's business expense, that does not go on your W-2. It's excluded, but your employer still gets to deduct it. So that is generally what employees like, because they don't have to pick it up as income, and the employer still gets a deduction for that. Then let's talk about deducting auto expense as an employee. So say your employer does not reimburse your business use of auto. Then you're going to say, well, I did use this for business purposes, and I'm going to deduct it as an itemized deduction on my tax return. So in this case, all the business use and personal use rules still apply. So you can only deduct what is your business use. The problem being is that when you deduct it on your Schedule A, there's something called alternative minimum tax. And because this is what's considered a 2% employee deduction, it's not deductible for alternative minimum tax. So essentially, if you fall into alternative minimum tax, which in California, I'm afraid most people do, then you're essentially not getting a deduction for that. And in fact, it's very rare that I see people benefit by deducting their auto expenses on Schedule A. So it's much better that if you can, get your employer to reimburse your expenses, because then you're not going to have to pick it up as income, and the company still gets a deduction for it. One thing to note is if you're just lazy or you don't have a good app and you do not record your business use and you say, oh, I'll just deduct it on my return at the end of the year. If your employer does reimburse you for your expenses, you have to treat yourselves as if you were reimbursed. And so you cannot actually deduct that return, that expense on your Schedule A, if you can be reimbursed by your employer, whether you got reimbursed or not. So that's one thing to keep in mind. All right, so what happens if the company owns the vehicle? So once again, if you have a company-owned vehicle, you still have to use it for business purposes. So if you're commuting, what happens? You don't own that vehicle, your company does. And so what happens is your company is going to have to add back to your W-2 your personal use of that vehicle. And how does that happen, Stephanie? Stephanie helped us with this part of our business.
So actually at the end of the year, each year we send out notices to clients and we ask them for the details on the personal versus business use of their company-owned vehicles. And we will run through a calculation and provide this information back to the client. We do need to know the business versus personal mileage, the value of the vehicle, and when the vehicle was placed in service in order to do this.
Yeah, so it's based on your personal use, and a percentage goes on your W-2. I can't really stress enough how important it is to keep track of your business use, because like I said, auditors just prey on you, and 9 times out of 10, you're going to lose most of your deduction. All right, I think we have a question here. So there's a question that says, what are the record-keeping requirements for a company-owned vehicle? My understanding is there's a 90-day rule by the IRS. If you keep records for a 90-day period, you can use that ratio for business versus personal use for the entire year. That's true if it's got to be a typical year. So you can't cherry pick something. So if typically you're driving 5% business, but you have this 90-day period that you have high business auto use, that doesn't work. But you can use a period like that and extrapolate that to your business use. So yeah, that's generally the case. It's just that make sure you're not cherry picking. Okay, with that, let's have our next polling question.
Thanks, Dan. So our second polling question is another true false. And the statement is employee auto expenses are not deductible for AMT. Is this A, true, B, false, or C, not sure? We'll give you a few seconds to answer, and we'll close the polls in 3, 2, and 1. And it looks like about 70% or so said true.
And you guys got that one right. AMT, which we could probably do 2 whole webinars on, and no one would understand it still. You can't deduct those business expenses for that. So with that, we are now going to talk about calculating your auto expense, and we'll see Stephanie take over here.
Okay, so when looking at calculating expenses, there are a couple different determinations we need to make. The first determination is whether we're going to own or lease the vehicle. One thing to keep in mind is that this is not always a simple decision, and there's lots of considerations to take into account. So in terms of when you'd want to own a vehicle, a few of the considerations you should look at are depreciation. When you own your vehicle, you can depreciate it, but the options definitely vary by the type of vehicle you're going to buy, and we will look at the depreciation rules shortly and go into detail there. You also want to look at how long you plan to own the car. If you plan to keep the vehicle longer than the lease period would be, it's probably a good idea to consider owning, especially if you're the kind of person that wants to drive your car as long as possible. Mileage is also another key consideration. Since most leases have a mileage restriction and you'll get charged for excess mileage, if you plan to drive quite a few miles in a year, you definitely want to think about owning. Also, if you have cash available to purchase the car, it'd be a good idea to own, or if you have some cash for a down payment. In terms of leasing, a few things to think about. If you like to have a new car all the time and you think you're going to have a new car every 2-3 years, you probably want to consider leasing. You also probably have a lower monthly payment with little or no money down if you're leasing. So if cash is an issue, leasing is probably a good idea. Your lease payments are typically deductible when you lease. And one advantage here is that normally when you own your car, interest on your car loan is a personal expense and therefore not deductible. When you lease, the full lease payment is deductible. You also have no issue of disposing of the car at the end of the lease since you turn it back in and it's no longer your problem. When you own, you can sell it and get the cash for whatever it's worth at the end. So those are just a few of the typical considerations we would look at. It's not always an easy decision though. So one thing we have here available to us is some software that'll walk you through a lease versus buy comparison. So when we look at these calculations, we need some of the basic information like the terms of the lease, any down payment, how long you plan to lease, how much the vehicle would cost new, the percent you'd be paying on a loan, if any, and we can run it through our software and it'll go through and compare the two options on a net present value basis.
Yeah, it's funny, but generally the rule of thumb is how fast you're turning over that car. If you're, like Stephanie said, going every 2 to 3 years, almost always the lease is going to be a better tax savings for you. Where it gets harder is if you generally are keeping your car for a long time. Then in that case, it's good to run the software. Or most people, when they're keeping their car, just buy it versus lease.
So the next determination we usually look at in calculating expenses is whether you'll take the actual or the standard expenses when deducting your expenses on your personal return. So when you take actual expenses, you'll be looking at your actual expenses, out-of-pocket expenses for driving that vehicle. These would include gas, insurance, repairs, taxes, any other out-of-pocket expenses you have. You need to keep in mind that, again, you're going to need your business mileage here. And you also need to know when your vehicle is placed in service.
Yeah, the business place in service is important because of depreciation. So if you're owning the car, you need to know when you placed it into service so you can start depreciating it as of that date.
Right. And if you take the standard expenses, you need to have your mileage, and you multiply that by a standard mileage rate, which for 2015 is 57.5 cents per mile. So the calculation is much more straightforward.
Yeah, I think most employers make you do the standard mile expense. And one advantage of using the standard mile expense is that you can actually switch. You can switch that to actual if it's going to give you a better deduction, whereas you can't go the other way. If you start with actual, you got to stick with that actual. And I think there's some expenses, even if you take the standard mileage rate, that you can still deduct.
Right. You can also deduct expenses like tolls and parking in addition to your standard mileage. So we're now going to talk about the different depreciation options available if you purchase your vehicle. So the depreciation expense you're allowed to take depends on the type of vehicle you buy. The first type of vehicle we're going to look at is the passenger auto. And you might have heard people talk about the luxury auto limits in the past. This is where these rules apply. So they apply to the passenger autos. The first year of owning the vehicle, your deduction is going to be limited. And what's interesting is right now we're still waiting on any tax extender bills to be signed. So right now for 2015, we are not sure if we will have bonus or Section 179 depreciation available to us. In the past years, these rules have gotten extended every year, so they likely will be extended again. But for right now, we can't plan on having them. So the first year you own the car, your deduction would be limited to $3,160 in 2015. If 179 were to be extended, the limit would probably be around $11,000, but we don't have exact numbers yet.
And one thing to note on the luxury auto limits, I don't know if you caught it, but on a lease, in order to kind of copy that, there is an add back on your lease based on the value of your car. And that's there to approximate the luxury auto limits. And that's, once again, it's based on your personal use and value of the car and what year in the lease you had that car. And it seems a lot smaller than the depreciation luxury limit, but that's because it's this present value formula. But if you run all those present value calculations, they end up being equal at the end of the term. But that's one reason that if you're flipping these leases every 2 to 3 years, that you get a bigger benefit because you're deducting that lease payment and the add back seems a lot smaller.
So we've provided the passenger auto depreciation expenses for the first few years. As you can see, the first year we're limited to $3,160. Goes up some in year 2, back down a little year 3. One thing to note is that year 4 and after, you are limited to $1,875. Something to think about here is if you buy a very expensive vehicle, you're going to get the same deduction, and it's going to take a lot longer to recover the cost of the car versus if you buy a less expensive vehicle. So the next class of vehicle we're going to talk about is trucks or vans that are under 6,000 pounds of gross vehicle weight. So the maximum deduction you can claim in the first year for these trucks or vans is $3,460. And the reason you see a little bit of an increase here versus the passenger autos is because there's usually a little bit higher cost associated with operating these vehicles. Again, we don't know if Section 179 will be extended or not, but if it were to be extended, you would get a deduction of up to $11,360 for the year. And one thing to note here is that a truck or van with a gross vehicle weight over 6,000 pounds is not subject to these limits. And we'll go into that a little bit more.
And also, a truck or van is categorized by how the manufacturer categorizes it. And it has nothing to do with the truck or van's chassis. So you really have to look at what does the manufacturer call this. And it's a big deal because if you're a truck or van, as we'll talk about, it's easier to get around the luxury auto limits. And we'll talk about that next. But just remember, it's the manufacturer that determines whether or not it's classified as a truck or van, not the car's chassis.
So again, we've provided the yearly depreciation expenses for your reference. Year 1 here is a little bit higher than with the passenger autos. Year 2 again goes up. It's very similar. Year 4 and following, you get the same deduction.
And that's for the trucks that are under the 6,000 pounds and are subject to the luxury auto limitations.
Right, so some exceptions to the rules we've just discussed are going to be passenger vehicles that have an unloaded gross vehicle weight more than 6,000 pounds, trucks and vans that have a loaded gross vehicle weight more than 6,000 pounds, and qualified non-personal use vehicles. Some examples of a qualified non-personal use vehicle would be like a specialized delivery truck that might only have one seat for the driver, something like a mail truck, some vehicle that has a very specialized use that you're not likely to use for personal purposes. And again, these vehicles are not subject to the prior limits we discussed. Assuming 179 gets passed again, usually they qualify for up to $25,000 in Section 179 expense, plus their annual depreciation expense.
So yeah, that's a big difference. And I just want to point out that you notice that passenger vehicles are the unloaded gross weight, whereas trucks and vans use the loaded gross vehicle weight. So there's a lot of cars and trucks that if it's considered a truck or van that you're going to be able to get past those weight limitations and thus not be subject to the luxury auto rules. And in those, it's going to be simply, most likely a 5-year depreciation period plus 179 expense. And if we add bonus depreciation back again, you'd get that as well. So if you're going to buy a car and you're truck or tax motivated, you really want to get a truck and you want to make sure it's greater than 6,000 pounds loaded. That's going to give you your best bang for your buck. And right now it's not too late because the deduction, as we've talked about, is based on your business use. So even though if you buy a car towards the end of the year and you're only going to own it 2/12 or 1/12 of the year, if you drive that only for business or great part of business, you'll be able to jumpstart your depreciation deduction, which is something you would not get if you leased the car. So that's another factor for buying the car if you need a big deduction in year one.
So Debbie, let's move to our next polling question.
Thanks, Stephanie. So our third polling question, and again, a reminder for those of you looking for CE, you'll need to answer 3 of the 4. So if you've skipped one, make sure you answer this one. There is an exception for passenger vehicles with an unloaded gross vehicle weight of A, 4,000 pounds, B, 5,000 pounds, C, 6,000 pounds, or D, not sure. And again, for those of you who would like to see these slides, I'll be sending them out after the webinar. Get your answers in, and we'll close the polls here in 3, 2, and 1. And it looks like a good 85% said C, 6,000 pounds.
So it looks like everybody's paying attention. C is the correct answer. So the next topic we wanted to talk about is what tax credits are available for your vehicle purchases. And right now there's really one credit that is affecting most of our clients who are purchasing vehicles. The credit that's available right now is the plug-in electric drive vehicle credit. This credit was effective for vehicles acquired after December 31st, 2009, so it has been around for a few years. And it is for vehicles that are purchased for use and not for resale. They must be new vehicles, manufactured primarily for use on public roads and streets. And the credit varies from anywhere from $2,500 up to $7,500, depending upon the battery size. So the battery size really is the key here when you're looking at these electric cars. One thing to note is that the credit phases out when a manufacturer sells 200,000 qualifying vehicles for use in the United States. The number of vehicles sold is actually tracked on the IRS website for you. And we've included a screenshot here of what you can find on that website, as well as the actual web address. So if you look at this chart provided, the IRS will tell you what the total sales are to date of a certain make and model of a car. So if you're ever curious, I'm looking at buying a Ford Fusion Energy, for example, here, you can see how many cars have been sold so far, and clearly they're not even close to 200,000 in sales, so there's still time to get this credit. We've also included an example of the form you fill out when you purchase an electric vehicle. So you will fill out Form 8936. A few things to note on this form. In order to complete the form, you do need the year, make, and model of the vehicle, as well as the vehicle ID number. You also need the date it was placed in service. The form itself is actually a little tricky to fill out because it can be misleading if you read the exact lines. The second part 2 of the form, can really throw you off because it limits it to $2,500, but you really need to go back and look at the battery size in order to determine your credit and make sure you're taking the full $7,500 if you qualify.
Yeah, we had quite a few people in the Bay Area here, I'm sure in all of California, buying Teslas. So everyone wanted their $7,500 credit. But if you looked at the form, that caused a lot of confusion to people. If you are kind of a nerd, go ahead and Google, how much credit do I get for my Tesla? And you'll see all sorts of confused conversation based on this form because of the $2,500 maximum credit per vehicle that's listed on line 10 there. But the Teslas, you get the full $7,500, and just be careful if you're filling this out yourself.
So with that, we'll go to our next polling question.
Thanks, Stephanie. So our fourth and final polling question, again for CE, if you've missed one, make sure you answer this one. You'll need to have answered 3. Tax credits phase out when a manufacturer sells at least X quantity of qualifying vehicles. Is it A, 100,000, B, 150,000, C, 200,000, or D, 250,000. And we'll close the polls here, get your answers in 3, 2, and 1. It looks like it's 75% of you were paying attention. It's 200,000. All right. So Dan, maybe you can do a quick recap of kind of what we've covered today.
Yeah, so the first thing we covered was what's business versus personal. And as you recall, commuting is considered personal use, and that there was 3 exceptions to the commuting rule. 1, if you're traveling to a temporary workplace outside of your metropolitan area, and that is something that is truly temporary, meaning it can take place in less than a year, can't be open-ended. 2, if you have multiple work locations, then if you're traveling to your work location that is not your primary work location, that is also a deductible commute expense. And it's very important to note there that you have to have a primary work location or else they're all considered commuting. And then the third exception was the home office exception, meaning your office is in your home, so everywhere you go is not commuting because you can't commute to yourself. You're already there. Next, we went through what happens if your employee-owned car versus employer-owned car. The main takeaway there is that it's best for the employee, and usually break even for the employer, is if you're reimbursed for your actual business expenses. That way, it's not a W-2 compensation for the employee, and the employer still gets a deduction for it. We also talked about if you're deducting it on your own as an itemized deduction, that's going to give you limited help because, especially in California, it's not going to be deductible for alternative minimum tax purposes. And it's also, which we put up on the slide, subject to a 2% haircut as well. Next, we talked about how to keep track of your business versus personal use. And that, in an audit, is what normally kills people, is that they have not taken good records and they just get torn apart. So we have to be sure to, 1, at a minimum, write down your beginning odometer of the year and your ending odometer of the year. And for you non-engineers out there, get an app and use that to help record your business miles. Next, after we determined what the business use was, we talked about the different expensing methods. First, we looked at the 2 types of ownership you can have, either lease or own. With the own vehicle, what was important is your depreciation deduction, which the main item there is whether or not you're going to be subject to the luxury auto limitations or not. So any way you can get around those luxury auto limitation is going to give you the biggest deduction. Whereas with the lease, you're getting to deduct your lease payments, which includes a lot of those expenses that you would normally deduct as depreciation. Finally, we talked about the credit for plug-in vehicles. And big takeaway there is be careful if you're filling out that form because you might end up only getting a $2,500 credit when you could possibly be subject and allowed a $7,500 credit. So with that, why don't we take some questions if anybody has any.
Yeah, if you haven't already, please do submit your questions. It looks like we've got one in. So the question is, in the case of two work locations in different industries, how should the travel between the two locations be considered?
That's a good question. So if you're traveling from your home to one of those locations, that's not deductible. But between the two locations, that is considered business use. So anytime you're traveling between two work locations, even if they are not in the same industry, that is deductible. But if you say you traveled to your first location, then went home, changed, then went to your second work location, and they're not in the same industry, that both those are going to be considered commuting and not business. So you're better off bringing your change of clothes to your first work location and driving directly from there to the next. And one thing to note too is, say you're driving to a work location, but you decide to take a detour, say a 30-mile detour to the mall and do a little personal shopping and then go to that next location. Even though you're going from work location to work location, you're going to be limited to the miles that if you went straight there, that would be your business miles. You can't, just because of personal preference, travel somewhere farther to make that mileage higher.
It looks like we've got a second question regarding parking. So when a business pays for a parking expense for an employee, does the accountable or non-accountable plan apply?
It does apply because you can only deduct business expenses. So if there was no business reason for that parking, it's not deductible. So yes, that's still going to apply.
And it looks like another question regarding business-related travel. Does offsite training, learning, conferences, etc., especially for business-related certification, do those miles count as a business expense?
Yeah, so those are part of your business, assuming it could get more complicated. But if that was for something unrelated to your current job, then you got to look at whether or not it counts as an educational expense. But generally, if it's in your industry and it's making you better at your job, then yeah, that's going to be deductible.
And then the last one looks like it's related to the luxury auto limit. So how much is the limit and what does it affect? We covered that a little bit, maybe just a recap.
So the luxury auto limit, again, is referring back to depreciation. And pretty much all of your passenger automobiles are going to be affected by the luxury auto limits. When you're looking at the actual amounts, trying to find my slide, the first year limit is going to be that $3,160 for depreciation. But there isn't really an exact dollar limit on the car you're purchasing.
Yeah, it depends on how much your car cost. So for instance, a $100,000 car, normally say you take 20% depreciation for that asset. What's 20% of 100? It's 20,000. Your luxury auto limitation is going to be the 20,000 less the $3,165 limit. So it depends on, that limit depends on how much you paid for your car. So the more it costs, the bigger that limit is. So you're really just limited to that one depreciation amount. You just can't go above that.
And another question coming in, if you lease a car for your business, can you deduct the down payment in the first year?
Yes, if you do lease a car, you can deduct the down payment in the first year.
And sort of going along with that first year, is the Section 179 only applicable in the first year or years following?
Yes, Section 179 would be applicable to the first year. And then the following years you would take the deduction based on that chart we provided.
Yeah, 179 is always in the first year of buying an asset. So that would be a car, even equipment, anything that you depreciated. It only counts for the first year.
I think we'll have one final question to kind of wrap up. Folks might be considering maybe buying a car before the holidays. Is it too late, or what is the best time to buy a car to kind of take advantage of these tax savings?
Well, number one, don't buy a car if you really don't need it. And I think sometimes people lose sight of the fact that it's costing you money, and just because you get a tax deduction doesn't make it necessarily worth it. Because as of yet, we're still not at 100% tax rate. But now's a great time. If you have income and you need a car, this is a great way to jumpstart a deduction. So if you buy a car now, and I think I alluded to this earlier, you have the opportunity to deduct the business use of that car. And even though there's only a couple months left in the year, as long as you have a high business use, you're going to be able to take a high deduction, especially if you're depreciating it. And if we get these adjusted 179 and bonus depreciations passed through, you can end up taking a big deduction. And as I said before, if you really want to maximize that deduction, you're going to buy a heavy truck or van over 6,000 gross vehicle weight. Because if you don't, if it's just your passenger auto, because of those limitations, you're not going to get a real large deduction. So it's best if you have to buy a truck or van that's over 6,000 pounds, and you need it.
Thanks, Dan. So a quick note that Dan and Stephanie's contact information are on the slides in front of you. We did receive a couple of additional questions, and I'll make sure that they get back to you after the webinar. If you're receiving CE, I'll be emailing you this certification within 3 business days, and again, you'll receive the presentation shortly. So thank you all for joining us. Thanks to Dan and Stephanie, and we hope to see you for a future Armina webinar. Have a great rest of your day.